What does a 140-year-old soda company have to do with artificial intelligence? Apparently a lot. Coca-Cola just signed a $1 billion AI deal with Microsoft, and the outgoing CEO literally said AI was the reason he's stepping aside.
And while everyone's focused on the CEO transition, the real story might be the numbers. Zero Sugar grew 14% last year, pricing power is running hot, and free cash flow is on track to hit $12 billion.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're cracking open Coca-Cola, ticker KO, the most recognized brand on the planet, and a stock that Warren Buffett has held since 1988. Lana Chen is here to tell us whether this fortress is still worth buying.
Let's pour one out and take a look.
Coca-Cola needs no introduction, but the business is more complex than most people realize. This isn't just a soda company. They operate a portfolio of over 200 brands spanning soft drinks, juices, water, sports drinks, coffee, tea, and even ultra-filtered milk through their Fairlife brand.
The genius is the franchise bottling model. Coca-Cola doesn't actually bottle most of its own product. They have 225 independent bottling partners with over 950 production facilities worldwide. That means Coca-Cola operates more like a brand and syrup company than a manufacturer, which is why gross margins run above 60%.
The brand portfolio includes the obvious, Coke, Sprite, Fanta, but also Costa Coffee, Minute Maid, Topo Chico, Body Armor, and Fairlife. They reach consumers through 700,000 retail outlets and 8,000 distribution centers across 200 countries.
And here's the number that defines the moat: 94% global brand recognition. That's not just a beverage statistic. That's one of the highest brand awareness numbers for any product in any category in the world. Pair that with 54 consecutive years of dividend increases, and you have a stock that defines defensive investing.
The company is headquartered in Atlanta with about 54,000 employees. Revenue was roughly $48 billion trailing 12 months, with 76% coming from outside the United States. There's a changing of the guard at the top. Henrique Braun took over as CEO on March 31st, just over a week ago. He's a 3-decade Coca-Cola veteran who served as Chief Operating Officer and has held senior roles across Latin America, Asia, and global operations.
He succeeds James Quincy, who led the company for 9 years and oversaw a significant transformation from a pure soda company to a total beverage company. Quincy's parting words were telling. He said companies need someone with new energy and understanding of AI to helm the future. That's a pretty direct endorsement of Braun's tech-forward approach.
Wall Street sees this as a smooth transition. Braun is a continuity pick with an operational edge, and the stock barely blinked on the announcement.
Coca-Cola trades at $76.19 with a market cap of $331 billion. The trailing PE is 25 times and forward is about 24. For a consumer staples giant, that's reasonable. Not cheap, but not stretched either.
How does the top line look?
Trailing revenue is $47.9 billion. The quarterly cadence shows $11.3 billion in Q1, $12,360 in Q2, $11,850 in Q3, and $12,430 in Q4. EPS came in at $3.05 for the full year, up over 23%. What really stands out is the margin profile. Gross margins at 61.8% are exceptional. That's the franchise model at work. Operating margins run at 28%. Free cash flow was $11.4 billion last year, with guidance for $12.2 billion this year.
What about the balance sheet?
$10.3 billion in cash against $45.5 billion in total debt. That sounds like a lot of debt, but most of it is long-term and well-managed. The dividend costs about $9 billion a year and is covered 1.3 times by free cash flow. They've been paying and raising dividends for 54 straight years. The 28 basis points you earn is backed by real cash generation. Overall, Coca-Cola's financial health is solid. Exceptional margins, growing free cash flow, and a dividend that's been raised for 5 decades, though the debt load and currency exposure warrant monitoring.
What's the analyst view?
23 analysts cover the stock, 20 buys and 3 holds, 0 sells. The average target is $85, implying about 12% upside. The range runs from 72 on the low end to 90 on the high end.
So near unanimous bullishness.
Yes, and that's unusual for a company this mature. Wells Fargo has an overweight rating with an $87 target focused on pricing power and emerging market growth. Jefferies upgraded the stock citing operational momentum, and there's a growing consensus view that $90 is achievable if zero sugar and AI initiatives accelerate.
Last earnings were February 10th. Revenue beat expectations. EPS came in at 58 cents versus the 56-cent consensus. The guidance called for 4 to 5% organic revenue growth and 7 to 8% comparable EPS growth for 26. They're also guiding to $12.2 billion in free cash flow, which would be a new record. The bull case starts with pricing power. In a world where inflation has reset consumer expectations, Coca-Cola has been able to push through 5+% price increases without destroying demand. Latin America saw 16% growth, North America 8%.
Bulls also love the zero sugar story. 14% global growth last year. It's no longer a niche product, it's becoming the default choice for health-conscious consumers. That shifts the narrative from sugar water company to portfolio beverage company and gives Coca-Cola a credible hedge against the wellness trend.
The emerging markets runway is massive too. India is on track to become the third largest market behind the US and China. Africa and Latin America are delivering double-digit growth. With 76% of revenue already international, these markets are the growth engine.
Now the bear case. Currency headwinds are structural. When you earn 3/4 of your revenue overseas and the dollar is strong, those earnings get translated at a discount. 5 to 6% FX drag hit 25 earnings. And while 26 might see a modest tailwind, this risk never goes away.
Sugar taxes are spreading. Over 60 countries now have them, and studies show they reduce consumption 10 to 30% per market. Gen Z is less brand loyal than any prior generation and gravitating toward energy drinks and functional beverages that are growing faster than the cola category.
And tariffs are adding pressure on aluminum cans. Prices hit 4-year highs with 25% plus cost increases. Management says it's manageable, but if they can't pass through all of it, operating margins compress.
Let's compare Coca-Cola to the beverage peer group: PepsiCo, Monster Beverage, and Keurig Dr. Pepper.
PepsiCo trades at almost the same PE, 25.5 times versus Coke's 25.2. But Pepsi is more diversified through Frito-Lay, which gives them a snack business that insulates against pure beverage risk. Monster is the growth story at 38 times earnings with 10.7% revenue growth, but that's also nearly 50% more expensive than Coke on a PE basis. KDP is the value play at 22 times with solid growth but lower margins.
So Coke sits right in the middle of the pack on valuation.
Exactly. You're paying a fair price for the strongest brand and distribution moat, but not getting a discount.
What are options traders telling us about Coca-Cola?
The put-call ratio is 0.97, essentially neutral. IV percentile sits at 57, right in the middle of its historical range, which means the market isn't pricing in any unusual volatility. Call activity clusters around $80 to $85, lining up with the analyst target range. Puts concentrate at 72 to 75 for downside protection. The overall read is calm, conviction-light positioning, consistent with a stock the market views as fairly valued.
How about insider activity?
This is another yellow flag. Outgoing CEO James Quincy proposed a $25.4 million share sale in February ahead of his March 31st departure. EVP Beatriz Perez exercised and sold over 21,000 shares. Net insider selling was $15 million over 90 days with zero executive purchases.
The CEO sale makes sense given the retirement, and these are likely pre-planned transactions. But the broader pattern of no buying at these levels is worth noting. What should investors be watching in the months ahead?
The April 28th earnings are the next major catalyst. 3 things to focus on. First, organic revenue growth. Can they sustain the 4 to 5% range while navigating tariff costs? Second, zero sugar momentum. If it can maintain double-digit growth through the first half, the health-conscious positioning narrative strengthens. Third, the new CEO's first public commentary on strategy. Braun's vision for AI integration and operational efficiency will set the tone for the next chapter.
What's the verdict on Coca-Cola?
This is one of the most predictable businesses in the world. 62% gross margins, $12 billion in free cash flow, 54 years of dividend growth, and a brand that 94% of humans on Earth recognize. The catalysts are real: zero sugar, emerging markets, and AI transformation. But the risks are equally real: currency headwinds, sugar taxes, and a world that's drinking less soda.
At 25 times earnings, with roughly 12% upside to consensus targets, you're paying a fair price for a fortress. This isn't a stock that's going to double overnight, but it's also not a stock that's going to blow up your portfolio.
The key metric to watch is organic revenue growth. If it holds above 4% through 26, the dividend growth continues and the stock grinds higher. If it dips below 3%, the premium erodes and the stock goes sideways.
Let me close with a quote from James Quincy, the outgoing CEO. He said, "Companies need someone with new energy and understanding of AI to helm the company's future. The next wave of artificial intelligence is a reason for this transition."
It's a remarkable statement from a CEO who delivered 9 years of strong results. When leadership voluntarily steps aside to let someone better equipped for the AI era take over, it tells you something about where the company sees the future.
That's going to do it for episode 78 of Charged Alpha, our deep dive into the Coca-Cola Company. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.